question number 3. Okay. What are we looking at here? This is a question about interest coverage ratio. So I copied here a formula for you just to remind you how is the interest coverage ratio is calculated. But before we dive into calculations, let's first talk about why do we even care about what's interest coverage ratio? I mean, besides us answering this question in the Olympiad. Okay, so to really understand where the interest coverage ratio is used in finance, we need to understand what it measures in terms of what kind of information it captures. Okay, so when I talk about companies with my students, I like to think about drawing like a portrait of a company. One way to do that is to look at accounting numbers. Accounting means that it's a historical information. Okay, it's backwards looking, meaning that it gives you information about what happened in the company so far up to this certain point in time. Okay, so financial markets are typically aggregating information about future of the company. Okay, so there could be multiple portraits, multiple kind of ways of describing the same company. So right now we're going to start with accounting information. In particular, I'm going to look at the balance sheet. Okay, so balance sheet has left-hand side and right-hand side. On the left-hand side, there are assets. And again, we record them at the kind of historical acquisition value less depreciation. So it's going to be like historically, how much money did the company spend to acquire these assets? On the right-hand side, I will have liabilities. Okay, so this will be liabilities and book value of equity. It's very important that you remember this is book value of equity, not to be confused with market capitalization or market value of equity. The one is like share price times the number of shares. That's completely different concepts. Okay, so this will be book equity. Okay, so among liabilities, there are different kind of various liabilities that we can talk about. Some of them are financial, some of them are not. Okay, so financial liabilities, typically called financial debt, a very important concept in finance, that refers to debt or liabilities, obligations towards financial institutions. That would be markets, for example, corporate bonds, debentures, or that could be banks. So loans, syndicated loans, notes payable, all of these instruments where the company is borrowing from the banks. You might ask me, well, what other institutions that the company can borrow from? It can borrow from its trade partners, and that would be trade credit, for example. These things are not, they are part of liabilities, but they're not included in debt, in the concept of financial debt. Okay, so within liabilities, including within that, we can group them by their maturity. Okay, so maturity is like how long the contracts are for. Okay, so short term is typically under a year, and long term is 1 year or above. Okay, so in this particular case, this distinction is very important because this company is doing a little bit of kind of maturity switch. Okay, so it's taking some of its long-term bank debt and it's refinancing it kind of with a short-term credit facility. Okay, so long-term facility is charging this company 6% per year on its liabilities, and the short-term facility in this particular instance is charging it less. Okay, so in this particular case, 5% per year. You might ask me, well, wait a second, if this company can borrow short-term at 5%, why does it make sense to maintain any kind of long-term debt at 6%? Why borrow more expensive at 6% if you can borrow everything at 5%? And the question here is the risk. Okay, so the following risk is called rollover risk. So if this company, the problem with the short-term debt is that this 5% is not fixed. Okay, so today is 5%, next year it might be 7% or 12%. Okay, and so if this company borrows only with the 5% debt, in 1 year from now, it might find itself having to roll over this debt because the duration of the contract expired. It needs a new loan, and the only loans available might be at 12%. So much higher than the 6% right now that this long-term bank loan is giving it. Okay, so it's not that the company is kind of doing something unprofitable or irrational. It's actually quite normal that companies would have a mix of short-term financing and long-term financing. And in general, according like yield curve is upward sloping, meaning that the long-term financing is typically, again, outside recessions, is more expensive than short-term, and companies will have a mix of those financing on their balance sheet. So some of it will be financed with short-term, some of it with long-term. Okay. Now, so how does the interest coverage ratio enters all of that? So you need to remember, like, who runs the company? Shareholders do that. Shareholders run the company. Okay. Well, management team on behalf of shareholders. But the most important thing is that when decisions are made about which investments to undertake, it's the opinion of shareholders that matters the most. Okay. So the problem in its fundamental, it's not like some agents are just bad agents or like evil or something like that. The fundamental problem in the company is that shareholders want more risk. Okay. While lenders or kind of debt providers want less risk. Okay. So shareholders want to undertake grand projects, they want to risk it. It's because of their limited liability. Okay, so they don't share the downside risk to the same extent that the lenders do. Okay. So what lenders do to make sure that shareholders behave in a way that they, promised at the beginning, so that they're consistent in their preference and their investment strategy towards risk throughout the duration of the loan, is they impose covenants. There are two types of covenants, negative and positive. Positive means that performance covenants, sorry. Performance covenants means that there is a certain level of kind of profitability or kind of the standard that the company should maintain to be eligible still for the loan. And again, the goal is to make sure that the company does not invest in very risky, potentially profitable, but very uncertain projects. Okay, so one of these covenants could be they're typically written on financial ratios, and one of the popular ratios is interest coverage ratio. So what a typical covenant could say is that the company, to be eligible to still receive or use the, say, long-term loan from the bank, needs to maintain a certain interest coverage ratio, say 3.0. Okay. And essentially, the higher is the ratio, the higher is the earnings before interest and tax covering the interest. So in other words, the debt load of this company would be smaller relative to the profitability that this company is generating. Okay. So once again, so why are we calculating this interest coverage ratio? Because that's how lenders assess if the company is still performing according to its expectations in a way. Are they still trustworthy? Are they still kind of credit worthy of the money that the lenders are giving the company? Okay. So that's kind of the background. Now let's dive into the calculations. Okay, so EBIT in this case is $4 million. So this is 4 million. Interest coverage ratio at the beginning before any refinancing is 3.2. So our question is, how does it change once we take 4 million once we take 4 million more in short-term financing and repay 4 million of the long-term financing. Okay, so because we borrow more at a cheaper rate, our interest expense overall will go down. Our assignment here is to calculate by how much. Okay, so if EBIT is 4 million and interest coverage ratio is 3.2, then my interest expense before I do any refinancing is 4 million divided by the 3.2, which boils down to 1.25 million in interest expense. Okay, so 4 million financing we have. So how much interest expense are we saving? So delta is the difference between the interest expense. So I have 4 million that I'm going to take out on the short term and then repay the long term. How much money I am saving in terms of interest expense? It's 6% minus 5%. So it's 1% of 4 million. So this is 0.04 million. Okay. Now, new interest expense, therefore, is going to be 1.25 minus that saving, which is going to be 1.21. million. And the new interest coverage ratio, one, is going to be the EBIT of 4 million divided by the new interest expense of 1.21 million, which is approximately 3.3. Okay, so in that sense, the interest coverage ratio improves from 3.2 to 3.3, and the company appears, again, according to the interest coverage ratio, more stable, more creditworthy. Again, with a caveat. Okay, so remember where I started this question with, saying that it's not necessarily making the company more creditworthy or more stable, switching all of the financing into short term. If all of the company's financing is short term and needs to be rolled over, the company is exposed to the rollover risk, and that might not be visible on the balance sheet of this company. But when lenders evaluate this company for a new loan, for example, new long-term loan, they will realize that if a lot of the debt of the company is short-term, then this company is subject to that risk, this rollover risk. And the company might have hard time getting new loans at good rates. So that risk will be factored into the pricing of the debt instruments of this company if they were to seek financing. Okay, so once again, on paper, interest coverage ratio improves, makes company look better, but that not always does not always mean that the company is actually more creditworthy. Okay, so anyways, the correct answer is 3.3. And that's exactly matches up with the solutions provided.